Welcome to the CFA Society India podcast, where society members engage in conversations with industry experts to bring you unique insights. This podcast represents the views and opinions of the originally featured speaker and is posted with their express consent. The podcast is meant for educational purposes only. It should not be construed as research, recommendation, solicitation, or investment advice by CFA Society India. Now, let's dive into today's episode.
Welcome, Nitin, and thank you for taking time out and speaking to us at CFA Society. It's always good to have people from different backgrounds, wearing different hats to get a perspective. To give you a brief background, today we have Nitin Bhasin, who leads the institutional equities at Ambit, and who's driven this entire thing with integrity, ideas, and initiative. Nitin is a chartered accountant. He's a company secretary. He holds a master's degree in accounts. And in his past, he's been associated with MK, Way to Wealth, Kotak, etc. So welcome, Nitin. Let's get started from here. Let's kind of dive down and understand how is institutional equities business shaping up, and how do you see that as a categoric enabler for capital market growth?
Thanks, Chanchal, for having me. We have a huge amount of respect for the CFA as a qualification, as a degree, as a professional education for every. We encourage everybody to invest their time in becoming a better analyst, better investor, and a better professional in the financial services organization through this. I did myself complete the level 2 of CFA. Never came around completing it. Perhaps one day I would do so. Thanks for this opportunity, and let's dive into the question that you said about the institutional equities. Many people understand now equities has become sort of one of the most discussed topics in India. There are television ads, people are investing through apps on equities. But if you think about our country, which is one of the most talked about economy, one of the most talked about equity markets in the world, roughly a market capitalization of all the companies listed in India is close to about $5 trillion right now. And India is one of the most thriving and expanding equity markets. More and more companies have got listed. In the last perhaps 3 years or so, closer to about 200 companies would have got listed, many of them from across the country, which is not the case in the US. So it's an expanding market right now. But one of the biggest features that we have seen in the last 5 years since COVID is the remarkable entry of the individual Indian saver to save money into the Indian equity markets. As I mentioned earlier, a market cap of a country is closer to about $5 trillion. And give and take, if I was to look at all the equity mutual funds, give and take all the LIC money, retail investors, I wouldn't be surprised that 25 to 30% of that market cap, which is closer to about 1.2 to $1.5 trillion, is the saving of mostly individuals, retail, ultra HNI, or otherwise. So that's the institutions which are investing in India on the behalf of the individual saver. So just to set the context, that's the market that is. And these institutions, whether these are mutual funds or whether these are, let's say, insurance companies, they become the institutional investors. In the past, institutional investors used to be global funds investing in India. Now, this industry has become fairly mature, both FIs, foreign investors like the Capitals of the world or the Prudentials of the world, and now the Indian mutual funds like an ICICI or SBI or a Kotak, they all form the equities, the institutional equity investors of the country. But remember, they all invest on behalf of the individual shareholders. So that's our client base. That's what we work with. And most of these institutional clients, when they want to invest in India, we have to go to a broker. So we are an institutional equities broking organization which services most of these clients in India and internationally. And when you asked a point about strategic enablers, so remember now when the funds have become very larger, the responsibility of the asset manager is also very different from what it used to be earlier. And now India is no more a country yet to be discovered. The stocks are not yet to be discovered. The information is easily available. So now as a country or as a market, we have evolved from somehow getting an information of a good company and doing a basic analysis and investing in it. Now, when asset managers are running as closer to 1 lakh crores, 2 lakh crores, 50,000 crores, they need insights which are very useful, which are non-biased, which are relevant, which are servicing the needs of a short-term investor and even a long-term investor. So that's how the service of the institutional equities, a broker like ourselves, which offers services both in research as well as sales trading, and the other allied services like a sales service or a corporate access service. So we become one of the key contributors to the investors or investing on behalf of the unit holders to give them insights on what sectors, what could be the earnings, where could the markets go, how should they do asset allocation. But more importantly, if I was to just, bring some point that what at Ambit we did 10 or 15 years back, we brought into the investing lexicon of India with some great investors have spoken about called good and clean investing. How to
Right.
look at companies to think from good quality management, good quality accounting, how do they work on capital allocation, what are great managers. That's number one. Bringing corporate governance into a lot of discussion over there, bringing a lot of competitive advantage into discussion over there. So I would say trying to give specific and useful insights for investors, institutional investors to make a decision. Not only that, but also trying to bring every now and then new ways to think deeply, like accounting quality, corporate governance, promoter quality. I would say that is the strategic role we have played.
No, I think that was a very nice answer to the question that I had, but I'm going to play a little devil's advocate to this entire conversation over here. Uh, how do you see the role of institutional brokers shifting from being more transaction oriented or, quote unquote, being called brokers to being looked upon as the managers or partners who have better insights on the overall portfolio building system for you said mutual funds. So for mutual funds, how have they shifted the view from looking at you being just a broker to more somebody who can give better insights?
Very, very interesting question because I think I used in my previous answer a few times the word that we are an institutional equities broking organization. I think when it was a small market, a decade and a half or 2 decades back or 3 decades back, the role of the broker was very different, perhaps because the expectations from the investor were also very different. And as the market is becoming more and more bigger, more regulated, more nuanced. When I say more nuanced, think about the role of ESG. Understanding what is UPSI and what is not UPSI. So, which is unpublished price sensitive information, which we learn a lot at CFA education again. So, these sort of things becoming a lot more nuanced. And that's where, as we are becoming a very well spread market in terms of multiple kind of asset managers. Remember, institutional investors in India were very few, globals were very few. But now there could be hundreds, if not thousands, yet investing. So hence, what are they looking at? They're looking at people who can give them an unbiased view, who can give them something an independent view. Perhaps the broking industry is in India and internationally well known for perhaps serving their interest first before the investor. And I think that's changing because a lot of seasoned analysts are becoming fund managers. Global asset managers are putting up their businesses in India. A lot of professionalization has taken place in both the sides, whether it is broking or whether it is asset managers in India. And hence, that is leading to not just being transaction orientation demand from the customer or the broker. And this sort of becomes a feedback loop in which the broker also says, okay, what is expected of me? So I would say if you read the last 10, 15 years of the new kind of institutional equities broking firms which have emerged in India, and there are a handful of them apart from Ambit from the vintage of 2010. Some of them have gone out and created some very good research-based broking, non-biased broking, not necessarily only built around corporate access, not necessarily also built around being partners as what the global firms could be to the
Right.
investment banking business.
Right.
We have a thriving investment banking business, and we as a broking business also work with them in certain business requirements where it is supposed to be. But we exist independently, we collaborate where we have to, and where we see. But globally, I think what we are seeing is in unique markets like India or other regions also, investors want uh, services of good quality research, good quality ideas from good quality promoters, etc. And hence, that's how it is evolving from just being transaction oriented. Because earlier, if I was to just give you a little bit more context, earlier, investment was a function of limited supply of paper in the market, limited supply of number of companies in the market. Today, there's an abundant market. I said $5 trillion of listed market in India. The float of India could be anything between 20% to 30%, which trades very often. So now there is enough amount of ideas. So hence, it's not about unique access anymore. It's also about timely service and timely ideas. And hence the evolution from simply a transaction oriented broker to an opportunity to build an insight driven partnership with global asset managers and domestic asset managers. And if I was to update you that at Ambit, I think the last 10, 15 years, we take pride that not only we work with some of the Indian leading asset managers who, who appreciate our team's work, but also many of the global asset managers, which are long onlys, which are boutique companies, which invest in companies for about 5 years and 10 years. Roughly more than one third of our business today comes from global investors. Clearly, we could be one of the handful in India which have evolved from a simple broker to insights based service provider, but also giving them transaction services both in daily broking and even growth capital opportunities.
No, I think that was another interesting answer. And what I really liked about the whole differentiation that you're creating between your research team and the iBanking team, and there is and always a need for Chinese wall between these two teams, to service the client to the team. I'm going to get you to the buzzword, which is AI, right? Everybody is talking about and everybody is trying to figure out how AI is going to transform their businesses or take away their jobs. If you had to put some insights on it, how do you think tech is transforming the whole research in terms of research delivery of notes, in terms of better analytics, in terms of deeper insight into the business? How do you see tech overtaking some of the analysis that your team does? And how do you see tech being an enabler to the whole or overall delivery that your system has?
I think this is a question which can take hours to answer, but I'll try my best over the next 5 or 6 minutes to give how I have seen as an analyst over the last 30 years or 25 years, the usage of tech. When I think about these things, I remember myself in the late 90s or the early noughties, making charts with scale on a large paper. And
Yes.
now we have charting tools available. I would say reading annual reports on thick books like of annual reports and punching that data into Excel sheet. But today I would say, that doesn't exist anymore. You punch a name and you can actually get what sort of a chart that you want, what sort of a data. Earlier we used to put it on our own through using certain tools. Now it's all available. So I would say technology has been, whether it is AI now or whether it was Excel to begin with, or whether it was databases offered by services providers outside, it's been part and parcel of every investor, whether you are an asset manager, whether you are a trading guy, whether you're a salesperson, or whether you are even the analyst. I would say they have been using. Perhaps it's going to become much more challenging and interesting for the analyst in the next 5 or 10 years. What we are seeing is what when there is an abundance of companies, as I was telling you in the beginning, 5,000 companies, perhaps a single individual shareholder portfolio, which is a mutual fund, a large mutual fund, will have 500 to 600 stocks. How do you give them ideas? How do you find ideas when there are 100 companies? I think it will become through using a lot of technology to sieve data, to see which companies to focus on, not to focus on, put in trackers. I think perhaps technology appears like to the uh, non-user of the technology in the early days, it's a friction to adopt that technology. But once you use it, it can become much faster. You don't have to go beyond. So I would say AI or the other things which are come into the life of the analyst will come in multiple formats. The first format could be they're trying to understand what's happening in the world market. Earlier, I used to have to go to a Google, search hundreds of documents and read all press reports. Now we can actually intelligently use so many tools to summarize what's happening. Let's say, for an example, what's happening in the cement industry in the USA, how it has evolved, and you can do through one or two or three sources and get multiple views of different AI, different chat AI, different AI tools, etc., which then perhaps an analyst can summarize, okay, this is how the America's cement industry evolved or steel industry evolved, and what does it mean? Or even culling out the data. Let's say I want to compare an Indian cement company to the emission norms of cement companies in the US or in Europe, or what are the emission norms that the European companies talk about. I think a lot of global research, which was very difficult earlier to learn, where Indian companies, because remember, Indian companies will catch up. Indian regulations will catch up to global companies. I think that's one of the very basic examples of using these new AI tools or search tools to do research. That could be one. But I would say there are new tools coming through a partnership that we are exploring with one of the homegrown AI financial research providers, in which we can just simply search on, let's say, through the transcripts of hundreds of thousands of companies, which are the companies which are talking about the supply chain of GLP-1 in India, who all have spoken about that. Can you imagine an analyst or any fund manager wanting to do that without these tools available earlier? So, so the job of the analyst will become imagination. When I started my career in the 90s, it was all about the first I, which is the information gathering. And then from there, we actually had to go to create insights from that information. And from that information, to give ideas to the client. Now there are abundance of ideas in India. Perhaps we also have to see for long-term differentiation, and an asset manager is looking at the analyst, either in his team or outside his team, to service providers like us. What is the imagination? What could happen tomorrow? So hence, now base level analysis, base level information gathering can become much easier as compared to earlier days. And if an analyst puts in the time, they can learn more and use their time to imagine and come with thesis and check their thesis or hypothesis using these tools. I think that is one of the examples I would say in terms of doing base level research. Perhaps also, so many of our analysts keep so much of data of the past and create these Excel sheets. You know, certain chart formation, certain comparison to macro data and your company data. There's so many ways that if you can start asking the right kind of questions to powerful engines, and you have built some sanity checks, you can use these tools to not only create productive efficiency, but also, I would say, new ideas to put in front of the clients. Can improve in data analysis just beyond simple Excel sheets. And as I said in the beginning, how do you use these tools? So it's interesting times. I'm pretty excited because it just helps me. Like I've been using it for the last couple of quarters, is to a simple question, creating my own analysis of what's happening in the banking sector with on 6 questions, or prepare a table comparing everything on what they're talking about technology. Earlier, it used to be so difficult. Now, the data available to convert speech to text. So I would say base level tasks will reduce. So hence, the knowledge worker will have to rise up. As the analyst, the knowledge worker will have to rise up one more level to just move from simply gathering analysis information to giving relevant ideas and putting some imagination, because some base level grunt work will become table stakes.
No, so this is interesting. And you mentioned that I think the role is to provide productive ideas to the clients. I'm going to hold you on that. And I have a related question which says that what is next India? Or if we call it India 2.0, right? India 2.0 is practically something which we didn't experience in the earlier phase. There are a lot of talks that the stocks that we see in the benchmark today or the large caps today could not be the large caps of tomorrow. And tomorrow's India could be very different from what we have seen in the last decade or so. Now, tell me something. Isn't institutional research covered around top market cap stocks where practically all the news have been priced in? But the new India seems to be in the lower trail of the pyramid, which in some sense has attracted renewed interest from FIIs. How do you see research organizations like yours changing the whole philosophy or trying to come down to the lower trail where there is just a lot of interesting movement happening and where there's just a lot of renewed interest from FIIs?
Great. I think another very interesting one, a subject close to our heart at Ambit over here. Let me tell you that here in India, it's very, we have to see at the US how it has also evolved. US also has thousands of companies. It's just the economy is so bigger. But over there, the number of companies has been shrinking. Uh, but also over there, multiple kind of investment banks, equity research houses, and even asset managers exist. There is a S&P 500, there's a NASDAQ, there's a Russell 5000, and there are so many asset managers which only focus on micro cap companies or small cap or mid cap. And yes, that is where India is very different because over there you would never see a large institutional equities broker, even a small one, having coverage very similar to India. Because in India, roughly, let's say Infosys would be covered by about 45 to 50
Yeah,
brokers.
maximum number of people, I'm sure.
Yeah,
Yes.
and whereas in the US, you might actually see that some of the leading companies, like a JP Morgan Chase or an Apple, at least about half a dozen years back, was not even covered by about 25 people or so. It's a clear segmentation. And I think one of the reasons for that could be because in that market, there is no promoter shareholding of that nature, what you see in India. Remember, of the $5 trillion of market cap of India, roughly 50 odd percent could be held by promoters, which includes the government being the promoter also, which is not the case there. Founding shareholders. It's an institutional market. So hence there's a large, small companies are also have a reasonable float. Large companies have a mega float, but that's not the case in India. And hence a lot of brokers land up covering 50, 100 stocks. But that world is changing, Jancha. Today, as I said in the beginning, we are expanding our coverage, expanding our market cap. The number of companies listed in India is much, right? But the top 100 account for a large part of the market cap of India because of either A banks or very, very big companies. So you will see that most of the top 100 companies are covered by 30 to 40 brokers very uniformly with few gaps here and there. Today, all of my peers, whether it's bank-based broking firms or otherwise, they all cover anything between 300 to 400 companies,
Correct.
which is a fairly large number. So when you look at 300 to 400 companies, map that with the client like an SBI mutual fund or an ICICI Pru or a Nippon, they may be owning closer to about, you could say, 400 to 600 stocks with very active ownership of about 300 to 350 stocks. If you look at the FIs, they may be owning like Capitals and the Fidelities, the world 100 odd names, 150 names. They're also going down the market cap curve. But mostly FIs will not cross 40, 50 stocks in India at any case. So you can see that there is like HDFC or a Kotak 25 years back was the emerging bet. People are going down the market cap curve also to find India 2.0, India 3.0, or the rural India or the urban India, whatever you call it, looking for ideas for the emerging market. So we are, as brokers and institutional equities service providers to our clients, also responding to our clients' demands and covering smaller cap companies. Of the 300 companies that, oh, sorry, of the 200 and odd companies that we cover or our peers cover, remember, India has only 100 large caps. So everything after that is mid cap and small cap. But yes, we have been one of the few brokers who've been putting equal amount of depth of work analysis. I don't say we are the only one. We are one of the few, I would say, having putting equal amount of depth, or perhaps sometimes even more, to find the multi-baggers of the years to come and finding good quality companies. So let's say we have yesterday covered a company called MediAssist, or we have in the past covered companies like Safari, which nobody used to cover at some point in time, 5 or 6 years back, or even many years back, companies like Astral or Senco Gold today. These are not the companies which are, let's say, India 1.0 or even the top 200, 300 names. But now they've become talk of the town because they've evolved to create wealth for investors. So hence, we and our peers are going down that route, responding to the client's requirements and covering more. And we also plan to cover more of mid cap and small cap, but companies, and perhaps even find newer ideas which could become tomorrow. And that's one way to look at it. The second way to look at it, as you asked, how the India would look of the future. I think India will remain India, Sanjay. India's Nifty could change. India's Nifty has changed. India's Sensex has changed. In the 90s, we used to talk about the top 30 companies. Most of them don't exist in the top 30 anymore.
Correct.
Nifty of the 90s is not the Nifties of the noughties, and today's Nifty is very different. And I dare say that in the next 5 or 10 years, if we put up another 100 companies to list in India, and the institutional investors continue to come in the way they do, we all will be talking about NSE 100 or the Nifty 100 more so than the Nifty 50, because
Nifty.
Nifty
But
100
that
has a
makes me
slightly
pleased.
better representation than
Correct.
Nifty 50, because that's what the reason was we moved from Sensex to Nifty 50. Uh, I think that we will change. Perhaps the proportion of the banking that we see in our country is very large in the Nifty today, or the BFSI little north of 30%. So perhaps that will change. But I think the big change will happen is, remember, in India, we have a large unorganized economy. If you see, or if you read the tea leaves, how Zomato has become a platform on which unorganized food and beverage industry, or now how Blinkit, the platform of Zomato, has brought in sort of the modern retail trade format of India. Remember, we all thought that the Kirana stores would move into big mega stores, which never happened. But now the dark stores have become the new Kirana stores from whom the goods come to us. That's where we are going to a value capture, where the FMCG was FMCG, but new companies are getting listed over there. So perhaps in the times to come, there could be businesses which become bigger by capturing the uh, transaction value or the value of that industry. What we saw in FMCG getting captured at the delivery to the customer stage, when it was about what you call Blinkit or Zomato for the restaurant. The amount of economy, it's a large economy, but has no representation in the Nifty 50 or Nifty 100. With Zomato, it comes there right now. And you will see examples of this emerge time and again. Example again, one of the ideas that our team has been writing on called Policy Bazaar. So they again a play on the formalization of the agency network of insurance broking, or for that matter, you can think about new entities like which are becoming the retail investors investing in the stock broking industry, and organized platforms like Grow and Zerodha, reducing the friction for millions of people to come over there, and they capturing the value of that industry. So hence, what the big thing that would happen in the next 5, 10 years is not only emergence of more and more companies from smaller pockets of India. Now I meet companies in Indore. Now I meet companies in Odisha. Now I meet companies in Kanpur. Now I meet companies in Ludhiana. Smaller towns everywhere. Or even now, Raipur.
Yeah.
A lot of steel, organized special steel
Yes.
companies. So
Correct.
the representation of corporate offices will change, but India still has smaller companies. They will also get listed, but also the Nifty level companies will emerge from companies which will become a larger platforms to capture value of bigger unorganized industries in India. One of the examples you can think about, Chanchal, is HDFC Limited many years back was capturing the value of the entire Indian real estate when no Indian real estate was finding itself listed in the Nifty or Sensex, whereas HDFC was a big mortgage player or play on the India's real estate. It was a proxy play to that. So hence, I would summarize it like that. The India 2.0 or India's next India will have two or three vectors, more smaller companies from across the country, much more newer industries, whether it is startups or whether it is exports or consumer, because they will find a risk capital available to themselves in India. And number three, as I said, different kind of startups, very similar to akin to what Amazon did or what Zomato did, but in other industries of India.
No, fair. I think the takeaway from me is better indexes because you mentioned Nifty 1000 and 2000. I think I'll be excited to see how that index formation happens. Love to talk macro over here. We've spoken about business research, how tech will evolve. But I never let an equity manager or a CIO go before I take their two bits on the situation. Now, the first obvious question that all of us have in our mind is what is your 360-degree perspective on the whole tariff situation? Where do we stand in terms of India? When it started off, people were confused, but as it stands today, people are optimistic, and there is this view that's formed which says that probably India is in a better shape. If that's the reason, where are the FIIs? Why don't we see them coming back in this volatile world? Because if everything is not too great, in China or in US, why are we not seeing FII flows coming back?
I would not want to sound like I don't believe in many of the themes that sometimes come out, but I would try my best to answer this in a manner which I see today. I think in the last 20 years, I've heard this story play out at least two or three times.
Oh,
In 2005, it was that the China's opening up and tariffs, the WTO controls will lead to India becoming the textile uh, alternative option to China. But somehow we celebrated it too early.
hmm.
And one thing or the other, we never became a much bigger uh, textile nation despite having our own cotton. 15 years later in 2020 or so, everybody said China plus one. And I think it's been 5 years. We all have been now finally forgotten that name, China plus one. And now suddenly tariff. So for some reason or the other, India has not achieved global scale in the global supply chains. Barring the businesses of pharma or barring the businesses of IT especially because from the day one, it started off the world as a market for itself. So hence, the challenge is if you don't design the industry or the business from day one as the world as a market, it becomes very difficult later on for us to catch up. And when world as a market means that all sort of resources, whether it is the friction in land, whether it's the friction in labor, or whether it's the friction in quality of labor, all has to be solved from day one. So I think this entire China plus one or tariff, we need to reflect as a country. Do we celebrate? Do we hope? Or do we plan ahead, looking at learnings from the past? I don't know whether the tariffs of today, what does it mean for India? I would say we need to think about that these tariffs could be a function of the political compulsions of the US. So hence we need to plan differently for ourselves. We just simply can't say, here's an opportunity, let's capitalize. Opportunities benefit the people who are prepared. We just have labor, Chanchal as a country. We don't know whether that labor has the right kind of skills, the right kind of productivity. We have a reasonable amount of large tracts of land for evacuate manufacturing capacities or manufacturing output from India. We celebrate way too fast. I would say, hence, coming back to the point of tariffs, things too early to count that we are a beneficiary. There will never be true winners or losers in such a scenario because tariffs generally lead to a deadweight loss in India. India's perspective is, in that sense, is a little bit more, I would say, how it uses its uh, relationships in the market, negotiates in the market to assuage US by granting them some sort of concessions, but not actually give away too much of the domestic market. In India is a very big domestic market. A lot of production happens in India for its self-consumption, unlike the China, where a lot of manufacturing is about exports. In India, most of it is a consumption. We are a bigger importer than an exporter in the global merchandise trade. So I would say India is not worse off as compared to others, but very difficult to say that we are going to be a very successful out of this tariff. I don't see it right now, but if we are looking to find hope, we can make it a hopeful situation. India's reliance on domestic growth drivers uh, is always been very high. Our mindset has been very cautious. The 6.5-7% growth in GDP in India is a good driver. A lot of premiumization is happening for the domestic consumption. We are doing so. Uh, so so I don't see. I would want to look at tariff as a big winner for India. I could say that India could cut tariffs on about 20 to 25 billion dollars of goods, which is the 50% of imports from the US. And India could increase its imports of crude and defense products to reduce the trade surplus from the USA if one was to be looking for a specific answer. That's how they could play these one or two things to uh, handle the relationship with the US a little better. I doubt if in 5 years the China plus one hasn't played out, that in a very hurry, the tariff alternative manufacturing to India will happen. So I would be a little bit cautious or would suggest a little bit more realism to think to that. To the second point that Chanchal you said, where are the FIs? I think FI has been there for years. They're one of the most loved markets. If you travel across the world and meet global investors, they all like India. You know, Capital loves India, Wellington loves India. You name about it, people have been investing in this. Versace likes India. You know, the global asset managers, they talk very good things about India. They've been here for 30 years, much before the domestic institutional investors also came. So hence, I would say today, however, for the last 6 or 9 months, uh, they've been talking about has the performance become much ahead of its time? If we could be looking at a country or a time where the economy is not accelerating, it is not declining. Remember, it is not the challenges, it is not accelerating at the scale that we are in. And the market caps become 5 trillion, but the economy is lower.
Right. Yeah.
And again, the consumption of the premium is happening, but the job creation for the masses may not be commensurate to what the demand could be right now. You know, one of the most interesting phrases is when you meet corporates in India and they keep on highlighting labor is a challenge when we know India is sitting on a demographic dividend. So, how to balance this could be perhaps the quality of the talent as well as the right price of the talent. And then there is the demands of the talent or the political compulsions, which also set the base level wages in India. So, all of that uh, are the factors in which FIs were investing. So, I think FIs have adopted a cautious, risk averse stance. They've been liquidating equities in India. They've sold about closer to 16 to 17 billion dollars in FY25, and this has been pretty much sharp for the last 6 or 7 months. Uh, you know, most of the emerging market portfolios are looking for uh, consistent compounders kind of play, or companies which are changing from good to great. You know, they want next HDFC because very easy in the past to invest in HDFC and sleep. I think which is not happening right now. So you have to find for ideas. Uh, then in FY25, you see the huge amount of inflows changed. Whilst we had outflows of about 16 to 17 billion dollars, it's not that every sector and every stock saw an outflow, Chanchal.
Yeah.
There were sectors like media and telecom, healthcare, real estate. They all received about anything between $1.5 billion to $3.5 billion of inflows. Oil and gas, perhaps it could be Reliance or the other stocks, and consumer and BFSI, which led the outflows. And BFSI being so it's a balance between what they like valuations, what they don't like in either a earnings trajectory or valuations. Perhaps they've responded to valuations. Perhaps they've responded to sort of decelerating economy in India, I would say. That's how, or even the third factor, Janjan. The last year also saw, or year and a half, the debt cost or debt capital returns in the US become stronger. Remember, 3 years back, US had negligible rate of interest for a 10-year GSEC, which has increased now. Perhaps all of these have led to the fact that, but remember, market hasn't corrected much, very, very marginally, because it's the domestic institutional equity flows. The first point that we discussed, the domestic investor has become a really powerful, credible, and a consistent force to support the markets when FI has been selling.
No, I love the way you use the word consistent compounders in the HDFCs of the world that you need to reevaluate. In fact, my next question to you was, what are we? Are we China plus one or are we China minus 20 years, right? And I think you picked that up. But is it that bad, or what are the policy initiatives on ground that you see would have been a success or seems to be have a success in futures? There was this whole hue and cry about PLI or Make in India. Would you want to tag it as a disaster? Because I mean, Make in India was such a great propaganda, and I'm not too sure what happened on ground. So, what would be your two bits about China plus one, China's minus 20, and PLI or Make in India?
I was reading something on the weekend that roughly in the early 90s, India and China had a similar per capita GDP.
Yeah.
And since then the trajectory has been different. And I actually like to challenge that when people put out such things, because it's not 1991, it's actually 1978 one should be reading about, or 1967, that how China started thinking about reforms and opening up through Hong Kong, the connect with the open world, despite being the considered to be a communist socialism sort of a, and we were perhaps also, just not doing those things. So it's not the 91, because they liberalized in their minds much before. We liberalized the economy more in 1991, but per capita GDP was just a number. But the process outcomes of China were yet to be visible. I don't know whether it's India minus China minus 20, or it is China plus one. But I think if we have decided today that we need to become something very different in 10, 15, 20 years, we need to, as a country, go back and relook at many things. As I mentioned in the beginning, also is about how to look at things such as the education quality, whether you read about Korea, whether you read about Poland, whether you read about Germany. A lot of these countries are built around the quality of talent. It is not only the quantity of talent, it is also the quality of talent. So that has to be solved. So I think if I was to answer, I don't know, China plus one or China minus 20, but yes, we could be more closer to China minus 20 than China plus one right now. We need to start thinking about things such as infrastructure differently, availability of land, availability of labor codes, all of those things. But also at the same point in time, when we read about that India has a demographic dividend of about closer to 0.9 billion working age population, I would say 50% of those are women.
Yes.
And most of the Southeast Asian countries have done a wonderful job of bringing women into the labor workforce. And so is the case with most of the other industrialized world or the first world countries. As a country, we are one of the only countries in the world. We are perhaps one of the only countries which has such a poor women labor force participation rate. Perhaps it could be a reason that in the farm, the poor parts of the country, men don't work and women only work in the farmland, which is an unpaid labor. And perhaps in the richer part of the society, again, women don't work, but they contribute at home as the again as the unpaid work at home. So you got a large amount of unpaid work for women, and it's a I would say puzzle for the economist how to solve for this if that was to become part of the GDP. Remember, India's population of women, 0.4 billion women working at home. So hence, I think we have to solve for that, because that brings a supply which is very good for the factory. And you can see that most of the successful textile, electronics manufacturing uh, countries in the world have had more women on the shop floor, whether it's Bangladesh, China, Vietnam, Korea, and Japan. That's something for us as a country to learn from, the most basic starting point. I think if we can solve for that. I wouldn't say PLI is a disaster. I think it's a good wake-up call for all of us. At least the present establishment in 2020 around COVID made some very interesting, you could say, attempts to remind the Indian corporate that you can't build the whole country on the back of China. There's a very interesting book that had come out by Mr. Kant that Made in India or something like that. And on top of that, our finance, our foreign affairs minister, Mr. Jaishankar, said that, Indian corporates need not only rely on China to build India. India had become a land of traders. We are not investing in factories. I think there is a start. Whether PLI has not achieved all the objectives that we wanted to, but at least there is a start. Now people want to. Now market wants to pay for made in India. Now market wants to pay a multiple for companies. Now people want to provide capital. So I would say a start has been made. The results have not been achieved to what was spoken about. But remember, we have to start with some very pompous grand statements to wake up somebody or the industry and to move capital in that direction. Outcomes may have not been reached, suboptimal results, but they are course correcting themselves. And you can see in the recent PLI 2.0 for the components, they've learned from their past. We find it to be a credible improvement. But as one of the leading electronic manufacturing companies, the CEO tells me every now and then, PLI can just be a starter within. It cannot be the way to plan for the whole competitive advantage or the growth of the company. So I would actually posit that to say a start has been made, but I will again go back to the basics. We need to solve for factors of land, labor. I think risk capital is now available in India. Uh, Government says we need to back you up. People are waking up, but we need to find partners. The only thing that India has to solve for is one more after as land labor is technology, know-how, partnerships. When China was getting built, the Americans went there, formed joint venture partners and transferred technology, which Chinese used, put that, improved, made it a scale, and exported back to the world. Today, most of the manufacturing lies with China or China's extended companies into Vietnam or other parts, upstream manufacturing of high quality in Korea and Taiwan and Japan. How does India and the Indian government, Indian capital investors, Indian promoters form partnerships and invest along with them when very well knowing that countries like Vietnam, Malaysia, and Thailand are also wooing the same bunch of guys? And when India has a much bigger labor, can we become faster on other factors of production?
Fair point. I think this was very interesting. I have a last question before I let you go, and rightly so. This is the results season. I'm sure you've looked at companies which have started delivering results. What is the sense and what is the feelers that you get from the market? How have been the corporate earnings so far? What are the expectations getting into the results season? Has anything changed materially over the years in terms of expectations from these companies? And way forward, where do you see this going?
Sure. You know, Another relevant challenge, I think we've been highlighting this for roughly about little less than a year, that in India, there is a shift in the earnings happening, Chanchal. Uh, in the last 4 or 5 years before COVID, we used to witness that most of the sell side analysts, yours truly, and the firm also included part of that. We would start with optimism of high earnings growth for the country. And as the year progressed, we used to cut the earnings. But I think post COVID, that hasn't happened for about 3 or 4 years. Till about 24, either earnings estimates were being met or sometimes being upgraded, uh, either for margin expansions or otherwise. But that's changed in 2025. The earnings for the Nifty is just about 9% in FY25, and people aren't expecting, or let's say the analyst community is not expecting more than 11% for FY26. Shows you very, very low earnings growth, uh, because the data for this quarter is very anemic. Without relying on that, I would say if you look at on the Q3, which was the December quarter, we saw a large amount of we could say missing estimates. And that's been accelerating for the last 3, 4. Number of companies missing estimates has been rising than the number of companies actually witnessing upgrades or beating the estimates. So I think that's the underlying trend we have noticed. There is a lower PAT growth as compared, but underlying the PAT growth is the shift. Is the small cap and the mid caps which are posing lower growth, or the differential between the large cap and the small cap, the spread is reducing. More profit accumulation or creation is happening on the large cap companies or the mega cap companies with more than 3 or 4% of the weightage in the Nifty. So those are actually changing. So hence, I would say one is increasing number of misses, more polarization of profits towards larger companies, and banking sector and FMCG sector looking a little bit more relatively better off in the year that we are in, FY26, when it comes to earnings stability or less risk of earnings cuts. So this is a longer trend change on the shift of the earnings contribution from small more to large, and banking and FMCG. And we're looking forward to FMCG because if the input prices go down, which may happen because of the crude prices or otherwise, it was a very good era a couple of years back for India when margins expanded. It can play out in FMCG. If the WPI comes down and the CPI continues to remain over here, the CPI to WPI spread, if it widens, helps the margin creation of many companies in the consumption space or otherwise also. I think that is something positive to look out for. But remember, that is a very short-term phenomenon, Chanchal. The real thing that we're all looking for is revenue acceleration.
Correct.
The signs for that are limited, and revenue acceleration can happen, Chanchal, from 2 or 3 things. One is Indian economy accelerates. For that, more infrastructure creation, more reinvestments by corporates, either for a booming consumption in India or a booming export opportunity. I think all of those look a little bit uncertain or unclear right now. So hence, I would say revenue growth risk remains. There could be some CPI to WPI spread EBITDA margin possibilities, but we have to be cognizant that there's a profit distribution which is changing.
Perfect. This was very elaborate. Thank you for taking time out and taking us through such deep insights, Nitin. Look forward to many more such interesting insights from you. On behalf of all of us at CFA Society, have a great year ahead.
Thanks, Chanchal, for the opportunity. Looking forward to interacting with you soon. Thank you.
Thank you for listening in to today's podcast. Before you go, please subscribe to stay updated on your favorite podcast app.